Good morning, good afternoon or evening, depending on where you are in the world. I'm Jane Goodland, Group Head of Sustainability at LSEG, and with me is Cornelia Anderson, Group Head of Sustainable Finance and Investment in our Data and Analytics division. Welcome to our three-part webinar series where we'll hear from a range of experts around various industries in the lead up to COP27 in Egypt next month. Now, finance plays a critical role in the climate transition, and so it's very important that we review progress since COP26 and consider what we need to deliver at COP27 and beyond.
Thank you, Jane. And as you all will be aware, COP is an important point-in-time event every year that helps bring the conversation around climate to centre stage, and a lot has happened already this year. The challenges we've seen across the geopolitical landscape, challenges around energy security and volatility across global markets have really reshaped the discussions that need to happen at COP27 to keep the momentum up for our finance industry specifically, but also to achieve our broader climate ambitions. Today, we're going to talk about the infrastructure and commodities markets and how the sustainable growth discussions have impacted various market trends over the last year.
But before we jump into the discussion and the detail, let's have a quick reminder about some logistics. You should be able to listen to this webinar via your laptop or mobile devices and engage with the various widgets to the bottom, and also submit questions as we go along, and we'll aim to answer those at the end.
And also to remind our audience that this is the first of the 3-episode series of webinars. The next one will be on the 17th of November, again at 1 p.m. London time, and it will address the financing challenges and how we tackle the financing gap. And then secondly, we'll wrap up with a COP27 wrap-up, hearing from attendees of the summit and experts on how they think COP27 progressed on global climate discussions.
Now today we'll hear from various experts, including Darren Hawken, who joins us from Hong Kong, Ed Gomersall from natural gas, Ibukin Adebayo on African sustainable energy, and Bruce Olway on metals market, and of course Alessandro Sanos, who will provide his view on energy transition. Darren, why don't we start with you? Let's hear about some of the trends that we're seeing in the infrastructure space since COP26 last year.
Yeah, thanks for having me today. While 12 months is not a long period of time in infrastructure, if we look at the data and we cast our eye back to pre-pandemic, we can see that the infrastructure market was running roughly at around a 1.4, 1.5 trillion per annum in announced projects. Post COP26, we see that in 2021 jump dramatically to 2.5 trillion. And year to date, we are currently running at about 2.1 trillion in 22. I think the growth we've seen in that infrastructure space has definitely been with a focus to the renewable side, to the sustainable part of the infrastructure story, which I think very much leads us from COP26 into 27. Those numbers should continue to grow. There's no reason why they should not. There are a number of very, very strong factors pushing that. I mean, first and foremost, we have a political pressure combined with environmental issues. Obviously, every government is under pressure from their electorate to make those decisions, to make those calls on bringing to net zero their country's emissions. And a number of those governments, both at an individual national level and at a larger European level, have made significant moves towards regulation and announcing support. But I think one of the key factors that is often overlooked in infrastructure is the actual economic benefit it brings. Coming out of COVID, every government was looking for a way to boost their domestic economic situation. And we shouldn't underestimate how much of this infrastructure can play. Through the construction, through the manufacturing, through the installation of the physical assets, through to the maintenance of those assets, a significant amount of jobs are created in that market. And furthermore, there is an enormous amount of money spent on R&D in this space. So we're now looking at scaled batteries to drive a city's electrical consumption for 12 hours. We're looking at hydrogen at a scale to rival a power station. So there's a lot of R&D that goes into that space, and all of that produces great economic benefits for the host country. But like most things, there's a number of issues that infrastructure is facing. Those challenges, I think, are well known. They are issues around, the installation, around the supply chain, and more around geopolitical issues about sourcing the actual pieces of the physical infrastructure puzzle.
Thanks, Darren. That's really kind of interesting. Some of those numbers are really quite impressive growth numbers we've seen. Is there anything you'd touch on specifically around funding on sustainable projects themselves?
Well, I think the funding part for sustainable projects has remained constant. The banks are a very keen partner in this space. They have, through a number of different initiatives, all committed to playing their part in supporting that transition to net zero. They are very comfortable with this as an asset class. It suits their investment purposes, long dated, highly structured, in many instances, government backed or government guaranteed. So what we tend to hear about in infrastructure is that the money is there. The banks are available to finance. It's essentially a lack of bankable projects which really holds the market back. And if you look at the type of numbers we're dealing with, we're in the trillions for announced projects. But when we look at the project financing for sustainable infrastructure that was announced in 2021, that only totaled 35 billion. So many of these projects never actually reach a financial close.
Fascinating.
That's really interesting. Thank you for that, Darren. So there's a strong story in infrastructure and growth here, with infrastructure now hitting over $2 trillion. And I'm keen to take this to Ibucon and get a view on the African perspective. So COP27, as we know, has been dubbed the African COP. So Ibucon, why don't you share your thoughts with us around what is the outlook for sustainable infrastructure, in particular in the African region?
Thanks, Cornelia. And it's great because there's obviously another COP in Africa, the first one since Marrakesh, I think was 2015. So I think there's a lot of expectation. But one of those expectations is ultimately around the concerted effort that's required to focus on sustainable infrastructure for Africa. And what I mean very specifically there is energy-related infrastructure. If you take a look over the last 20 years, so from 2000 to 2020, around about $2.8 trillion worth of capital has been raised to finance energy infrastructure globally. Just 60 billion has actually been diverted to African infrastructure projects, which is about 2% of the total. Now, if you contrast that to Africa's contribution to global greenhouse emissions, which is about 6%, there's a little bit of an imbalance there in terms of what's happening, plus the loss and damage issue, which we know is happening across Africa right now with floods, for example, in Nigeria, and prolonged periods of drought in Kenya. So what's really required now is a focus on the $100 billion per annum gap, which is the amount of capital that needs to go into African infrastructure by 2030 to enable a just energy transition, and ultimately for African countries to meet their net zero targets and their nationally determined contributions. Now, Africa's population is also going to grow. According to the UN's population division, will double by 2050, so bringing another challenge where energy demands will increase significantly, and a reliance on old infrastructure, potentially driven by high carbon fossil fuel energy production, will create a further challenge. So the call for action is a big one, and it's a real one. And ultimately, the mobilization of capital across, particularly the capital markets functions, to support the efforts of the MDBs and public investment is very much called for.
Thank you. Let's talk a little bit more about the financing challenge there, because it's clear it's key to solving some of the transition issues ahead of us. So what's the approach to solving the financing issue for sustainable infrastructure in Africa?
So I think you could probably break that into two areas, Cornelia. And let's talk now not just about financing for infrastructure, but also the financing that needs to go into the technologies, because there's a huge requirement for deeper technology, more suitable, fit-for-purpose technology to allow for this energy leapfrog, as it's being called across the continent. Now, for public companies and the government, there is a healthy wall of capital right now and a lot of bilateral action which is going on, particularly from the donor governments, the likes of China, the UK, Germany, are all very active alongside the likes of the World Bank and other multilateral banks such as the African Development Bank. Since 2010 to 2020, so a period of 10 years, about $55 billion has been raised for those state-type projects. And I think that will continue. On the private sector side, a lot of capital coming into Africa has really gone to enable the independent power producers, so those providing private plays onto the grid. Now, these companies are being supported again by private finance, predominantly through the likes of the DFIs. So there are organisations and funds like the Green Climate Growth Fund, the Renewable Energy Fund for Africa, which play a very, very large supporting role. However, what needs to happen, again, is just to emphasise the point, is a different set of financing opportunities. There are some efforts to look at blended finance approaches. So, for example, tying overseas development assistance to mobilise private capital so that funding that is ordinarily for aid is going into the energy mix and the energy challenge. And that being used to create a multiplier effect from private investment. Then initiatives, for example, such as LSEG's voluntary carbon market is a unique new way of bringing more private capital into the African market. So I think these types of initiatives are going to be core to driving things forward. And let's remember what the opportunity is here for Africa. It's the opportunity for the development of carbon offset opportunity, which is at low cost, but extremely high impact in terms of its effects on the continent.
Thank you. I think there's no doubt that Africa is going to be key to a successful transition. And we'll cover the financing piece in our second webinar as well. Thank you, Bikun.
Thanks, some fascinating numbers there. And it's really clear that sustainable infrastructure and energy in particular is absolutely critical to achieve our global climate goals. So this is now the time where we have some audience participation. And we have a quick polling question to hear your thoughts on this subject. So you will see that there is a question on your screen and you can add your view by selecting one of the answers available. So the question that we want to hear from you about is, which renewable energy source saw the highest growth in new projects announced in the last 3 years globally? So was it was it wind? They're all energy. Wind, solar, biomass, hydro or tidal. So if you can put your answers in now, and we'll give a few seconds for us to gather the results, but let's turn to our experts in the room and see if we've got any views on the answer. Which ones do we think the right answer might be? Any ideas, Ivican?
I'm going to go for wind.
For wind,
yes.
Okay.
Yes.
Darren, have we got any views from you, maybe?
Yeah, I feel this is, I should get this one right.
You should shouldn't you, yeah?
That's right, exactly, yeah. I think by the number of projects, it's solar. It's so much faster to set up and launch a solar farm.
Yeah, okay. Any other divergent views at all?
Well, I think an interesting component here, right, is what Darren touched on, which is around the ease and the scale and the cost of these projects. And I think a really interesting trend here is how much the cost of renewable energy has come down in recent years.
So I can reveal that we've got the answers. So this is the wisdom of crowds has spoken. And we're seeing that the majority of the audience believes that solar is the correct answer. And I think indeed that is the right answer. So well done, audience. Followed closely by wind. So Darren, is that about right?
Yeah, that would be about right. I mean, generally speaking, if you look at the ability for those two processes to generate power, wind creates so much more, but is, as Cornelia said, so much more expensive and time consuming to install.
Great. Thank you.
So thank you for those responses. Some interesting views all across. The data that we have tracked via our Infrastructure 360 app and workspace suggests that solar is indeed winning the race on sustainable infrastructure projects announced in the last 3 years.
So earlier this year, I had the pleasure of sitting down with a number of industry experts at the Net Zero Delivery Summit to discuss key industry challenges and opportunities. And one of those conversations, I spoke with Andy Bainbridge, the Private Infrastructure Development Group Chair, on how he views the roadmap towards net zero and the critical role that infrastructure finance has to play in delivering climate action across frontier markets. So let's listen briefly to his thoughts on the subject as well.
We operate in what we call frontier markets, so DAC 1 to 3 markets in UN parlance. And I think the only way that you really get the money flowing to some of these markets is by proving that the risk is overstated. Banking and finance is really all about risk and reward, and I think in many of these markets, the risk is mispriced. So consequently, you can make sustainable profits year after year by backing projects in these markets because you earn a higher margin. So the Emerging Africa Infrastructure Fund, which as I say has been going for 20 years now, is sustainably profitable. It makes money. We get debt facilities now provided to it by certain banks and insurance companies and others in the marketplace who see it as a bankable prospect. So we have projects in places like Mali and Burkina Faso and Malawi, but we tend to find that every now and then you have a stress project. There's normally a way to work it through, and the loss record is actually much, much better than people think from the outside. And what that's done is it's transformed that perception over time. So people will now go into some of these projects without us. Now, the other thing that you do in some of these markets that is important and that we think is really important is using the credit enhancement capabilities, using the first loss capabilities of Garantco, which is also part of the Pitch Group, to encourage people to take the step they otherwise might not be able to. We've seen it work particularly well in markets where we've mobilized local debt capital markets, but also where we've had people come into markets purely because they know they've been able to rely upon our guarantee in the event that something goes wrong.
So if we're successful in scaling up the finance that's going to these emerging economies, is there the pipeline of projects to receive this capital, or is that another area that we need to focus on?
That's definitely an area we need to focus on. So some years ago, my predecessors at Pidge saw the shortage of projects in the pipeline and set up the Infracos, which are part of the Pidge Group as well, to do early stage project development, to take that early stage risk, which was really important and has done well. And similarly, the IFC has a similar venture. We think more is needed. We've been saying that for some time. What's really pleasing to me as an outcome of COP26, we saw the G7 report on infrastructure going to the UK government in December, I think it was, that specifically said there are 2 things that we should be thinking about and doing more about. And one is early stage project preparation. And the second one is the use of blended finance and credit enhancements, so such as guarantees, to bring in private sector more actively. So the dialogue is really starting to change. And I think what that means is that governments are thinking about how do we get that early stage project preparation? How do we do that without wasting money? Because obviously it's easy to throw money at a problem without solving it. Now, 2 years ago, no one was talking about this. Today, at today's conference, I've heard Secretary of State Kerry talk about it. I've heard Alok Sharma talk about it. It's really exciting to hear this being a mainstream dialogue now.
So let's now turn our attention to topics around energy as well as other commodities. Commodities play a vital role being at the heart of the transition discussions across the entire energy and infrastructure segment. So let me turn to Alessandro. So Alessandro, with COP27 and 28 both taking place in Africa and the Middle East, what are the expectations in the commodities markets around the transition discussions?
Thank you, Cornelia. And given that this COP is taking place in Africa and on the 30th anniversary of the Earth Summit in Rio, we can expect a greater focus on the issues of developing world and just transition. Today, the impact of climate change in Africa has been quantified between 7 and 15 billion a year. And if things do not change, the projection for 2030 is that this figure will spike to 50 billion per year. Now, when I look at energy, I'm afraid that there are no easy answers to the energy trilemma of sustainability, affordability, and security. The latest geopolitical tensions and the war in Ukraine have skewed the focus towards energy security. And around the world, several countries reopened coal plants or are even building new ones. And Europe is siphoning natural gas from Africa and Asia to replace LNG from Russia. Now, only time will tell if these are temporary blips that will not undermine national climate targets. But still, I believe that we have reached a point where we need to be intellectually honest and admit that there are no simple solutions to decarbonize the global economy. Switching from fossil fuels to renewables is not as simple as some people would like to believe. We should never forget that commodities have a physical dimension and that energy sources cannot just be swapped at will. When we turn on the light or the heating in our homes, even if we do not realize it, we are using an incredibly complex and expensive infrastructure. Energy molecules need to be extracted, stored, transported, refined, possibly stored and transported again, to finally be transformed into electrons before that light bulb turns on. To change all this and switch from fossil fuels to renewables, we need two things: a solid regulatory framework that supports the path to a net zero economy, and investments. And the good news is that the regulatory framework brought by the Paris Agreement has introduced legal certainty that allows prioritizing financing that supports the path to net zero. But there's still a crucial open question. What do we do until renewables completely replace fossil fuels? The industry often looks at natural gas as the answer, sort of a bridge fuel needed to phase out the more polluting fossil fuels. The thing is that natural gas is almost entirely made of methane, and compared to carbon dioxide, and for 20 years after it's been released into the atmosphere, methane traps 80 times more heat. So the question is, do we really want to use natural gas as a bridge fuel? Cutting methane emissions is the fastest way to tackle climate change in the short term, as it does not stay in the atmosphere for long. So from my point of view, we need to change the approach. Instead of focusing the discussion almost exclusively on the supply side of energy, switching from one energy source to another, we need to look at the energy demand as well. Energy efficiency and energy sobriety will be vital in buying us enough time to transition from fossil fuels to renewables. And if you look at energy efficiency, it is the quickest and most cost-effective way to mitigate CO2 emissions. It is mind-blowing, but we waste about 2/3 of all the energy we produce. When we use energy, whether in our homes, our cars, or in industrial production, nearly 70% of that energy is lost as heat. So improving our energy performance would be the second largest contributor to emission reductions. And with regards to energy sobriety, given the current geopolitical situation, and to minimize the risks of energy blackouts, this winter it will be essential to reduce the energy we consume. One example for all is heating. By lowering heating by just 1 degree Celsius, we can save around 7% of our consumption. So to summarize, from an energy perspective, now that we have the solid regulatory framework, and until the investments needed to transition from fossil fuels to renewables will start flowing, we need to focus on the demand side of energy. We need to upscale our technology to waste less energy, and we must all be more sober and reduce our consumption.
Alessandro, thank you. I think that's a really great reminder that energy efficiency is, of course, a critical component. But I also want to hear about your views on other commodities as well. Can you share some thoughts with us about that, please?
Thank you, Jane. It's actually a thought-provoking question. And actually, it is the reason why when I discuss the tectonic shifts needed to achieve carbon neutrality, I prefer the expression path to net zero to energy transition. And the reason is that energy transition skews the discussion towards the energy complex and creates a false perception that fossil fuels can be easily swapped with renewable energy. The transition to renewables requires substantial amounts of metals and minerals, and my colleague Bruce will explore this later. In a sense, metals are the blind spot of the energy transition, as are often omitted from the discussion despite being instrumental to the electrification of the economy. They are needed to expand the power grid, to produce the cables, the batteries, and so on. But simply put, we just do not have enough supply of metals and minerals to meet the insatiable and growing demand needed to achieve the transition targets specified by the Paris Agreement. So I think there are three main areas of concern. First, we have insufficient known reserves, and additional supply will not be available at any time soon. On average, it takes 30 years between the exploration, the development, and the delivery of a new copper mine. And increasingly stringent environmental policies on mining activities do not ease this long process. And if you ask me, I believe that environmental policies around mining reveal a certain level of phasing misalignment with regulation aimed at urgently reduce emissions. The second concern is that fewer high-quality ore deposits are left to develop. According to the WEF, the average cost of producing copper has risen by over 300% in recent years, while grade quality has dropped by 30%. And finally, geopolitics are another concern. Metals are characterized by a significant geographical concentration risk, and the current geopolitical turmoil and the war in Ukraine will likely accelerate an equilibrium in trade flows with the regionalization of supply chains and the emergence of trading blocs, or as Janet Yellen recently said, friend-shoring of supply chains. So unless we solve the metals and minerals challenge, I do not see how we will be able to successfully transition to renewables and electrify the economy.
Great. Thank you for that, Alessandra. And I'm keen to bring it back to the room and continue the discussion around metals. So metals are clearly a critical part of the path to net zero or the energy transition. So let me hand it over to you, Bruce, as our metals expert, and hear your thoughts on what we're seeing here.
Yeah, sure. I think, I'd echo a lot of what Alessandra just said. With regards to what are we seeing in terms of the acceleration of the transition, I think it's very instructive. Just pull up a chart for lithium price. Lithium, obviously, it's a key component. It's a battery metal, whatever the chemistry, and there's obviously a fight in terms of the chemistry that's coming through the batteries, iron, cobalt, nickel, or just lithium based. But lithium is ubiquitous in both. So lithium's definitely a winner. It's, I think I heard it earlier from Dareth, but it's definitely a geopolitical metal now, lithium. So pull up a chart, and it's essentially a metal which has come from a very kind of niche chemical product base to obviously this global stage, and it's got a lot of stage fright. Let's look at the price. 10 years back, lithium was meandering at about $6,500 a ton. Not a problem. 4 or 5 years, EV demand started to kick in. You had a price lift to about $25,000 a ton. That seemed like the spike at the time. Now it looks like a little bump in the road. Producers did actually respond quickly. To Alessandra's point, I mean, it can happen. And what we saw was a lot of new hard rock capacity coming on, mainly on Australia and Canada. You could probably say it was too much too soon. And obviously, lithium market then fell into oversupply. Prices dropped back to mean, basically, and then COVID, they sunk even lower to $5,500 per ton, if you can imagine that, to where we are today. $80,000 a ton. I mean, it's serious whiplash, it's vertigo, whatever you want to talk about the chart. I mean, this is what happens when a supply chain does not adjust to a new source of demand, as in the lithium space. So I guess in one way, it talks again to do we have enough metal to actually meet these transition aims. And I think obviously it's got a scarcity premium now at $80,000 a ton. Clearly the incentive price has been breached in terms of bringing on new supply. How quickly can that happen? Resource nationalism. I mean, there's a discovery from Rio Tinto in Serbia which has been stalled through to permitting. So it's about getting that social license, I think. And, you know, the longer we stall, the more carbon dioxide going into the air. That's another argument. But I think if we look at the consensus view, I mean, there's always your bulls and bears with extreme positioning. The consensus view is like, okay, short term, we've got supply constraints maintained. Medium to longer term, you know, lithium is geologically abundant. It is concentrated, you know, half of the resources mapped out are actually in the so-called lithium triangle, Chile, Bolivia, Argentina. But I mean, I think there's definitely, in terms of its geological abundance and worldwide abundance, there's scope to actually break out of that. So let's think about the actual supply footprint right now, you know, with a view that can we actually meet the demand requirements. I mean, you've got 90% of lithium highly concentrated from 4 countries of production in descending order: Australia, Chile, China, Argentina. If you look to, in fact, the processing capacity, that's even more concentrated. 3/4 are in China. I mean, clearly we've talked about the geopolitics, the, you know, kind of cleaving of Russia and China into a different kind of world order. There's no way that status quo can be maintained. You can't have, you know, 3/4 of lithium processing capacity in China in a world which obviously requires lithium to decarbonize. So, yeah, I think that's going to be a theme going forward. And, you know, to make sure that this shortfall in supply ends sooner than we kind of want it to without causing troubles, governments really do need to act. So I think, you know, forums like this and obviously playing out at COP27 is going to be critical to push that forward.
Thank you. We touched there on geopolitics, and we'll stay there for a moment when we move to natural gas. So let's have a look at some of the challenges that we've seen this year. Ed, we've seen major discussions through the year of our over-reliance on sources of natural gas from Russia. And we're looking at lots of switches. So perhaps you can just comment on natural gas transition to net zero and energy security, a massive topic. Share your views, please.
Well, as the gas expert on the panel today, it's good to be in demand this year. It's just a crying shame it took the war in Ukraine for that to happen. Geopolitics has been mentioned a lot in this conversation, and geopolitics and gas are synonymous. You can exchange one word for the other, and in today's conversation, they mean exactly the same. The situation in Europe can be divided into two. The acute impact that we are seeing from the war in Ukraine is now front and centre for households, industries, policymakers, and the wider financial community now. It is the most acute energy crisis Europe has ever had. At the same time, it feeds into longer term decision making and shines a spotlight on some of the vulnerabilities of the decision making that has been taking place in Europe up to now. And it also shines a spotlight on the decision making that needs to happen based on the fundamental shift in the energy mix this year. And those decisions, some of which will be taking place in Europe, will have significant ramifications, not just for Europe, but for more climate vulnerable markets around the world. In the short term, we have seen, as has been touched on previously in this conversation, Russian gas supply is now next to nothing. Europe is a gas-fed economy. It is the biggest gas importer in the world. It hugely, incredibly reliant on gas in its energy mix and for its economic prosperity. If you cut out Russia, you need to replace that volume of gas somewhere else. Up to now, there has been an incredible shift in trade flows, predominantly LNG trade flows, liquefied natural gas, as Russian volumes have curtailed dramatically year on year to, as I say, next to nothing. LNG has ramped up significantly. There are some capacity constraints and bottlenecks in Europe, but overall, volumes into Europe have increased by multiples. There is still a big gap between the lost supply and the diverted new volumes, and that is being taken account of by a pragmatic revisiting of what fuel Europe wants in its energy mix. So first off, coal has increased significantly, more in some markets than others, but there's been a significant revision on how comfortable markets are and European policymakers are having coal in the energy mix. Ditto nuclear. So Germany has been agonising over the shutdown, the phased shutdown, long planned shutdown of its nuclear fleet. It's made an 11th hour decision to extend its nuclear capacity. Now, there's a conversation to be had about whether nuclear fits into the green fuel or not. I happen to think it does, but it's also very much a geopolitical decision as well, and that comes back to one of the themes of this webinar. Now, longer term, the decisions that Europe has made up to now, and when I say Europe, I mean predominantly EU policymakers, is the issue has been that it's been mostly focused on supply side issues. So we've heard earlier from Darenth around how solar capacity, wind capacity are increasing exponentially. Investment in renewables capacity in Europe has been astonishing. It has increased significantly. However, there's not been enough focus on the demand side, so inflexible gas demand. As I said earlier, Europe is a gas-fed economy, and there are some sectors within the economy that can't shift. They can't shift away from gas. They're hugely reliant on gas, and this is predominantly in the industry like steel, cement, and so forth. And European infrastructure is decades old, based on gas. So from industry to residential, it's very, very much locked into that gas economy. And unfortunately, there's not been enough focus on that supply side. So yeah, you can increase renewable capacity till the cows come home, but consumers still need to consume gas because that's what they are locked into.
Ed, I'm going to ask you to stop there. I think we could probably speak all day about this. It's such a sort of enormous topic, but I'm really keen to have the audience have their say, if you don't mind. So it's time for another audience poll. So audience, we need your collective minds. The question that we want you to give your view on is, it feels a bit like a quiz. Which commodity saw the highest price increase in the last 2 years? Was it the carbon ETS, oil, natural gas, or nickel? So if you want to take your time, audience, to put your answers in. Again, we'll test our expert panel. Let's see who have got any views here.
I'm not going to answer this time. I got the one last one wrong.
So Ibukin is feeling a bit wounded from the last round. Alessandro, Darenth, either one want to?
There is one which is not in the chart, which is chocolate.
Chocolate. That's a curveball. Okay. Any other contributions?
Well, as the gas expert, I know what gas has done. So I know that's gone up incredibly high, tens of multiples times what it was previously. But
that's a bit leading. I'm going to just throw in the red herring then. What about nickel? I mean, the price squeeze, the suspension of trading on the LME could be interesting. could be a contender, but I don't think it is.
Could be a contender.
I don't
So we've got natural gas. You're the expert, of course. You're going that way. Ibercon's out, and potentially nickel, but maybe not.
Yeah.
And chocolate, of course.
And I think what's interesting here as well is some of the volatility and the swings, right? Because if we look at commodities, they've been through a lot in the last 2 years. So there potentially are some red herrings in here because we've seen some big swings up and we've also seen some big swings down in the market.
Okay, we do have the results in, Cornelia, so drum roll, I think. Well, it's probably no surprise, actually, but indeed, 44% of the audience got the right answer, which is, of course, natural gas. So for all the reasons that we've been talking about and Ed's shared his perspectives on. But thank you, audience, and lots of you got it right. Thank you.
Excellent. So thanks for those responses. Look, I'm keen to just pass it back to Alessandra for a minute here. So Alessandra, tell us, what's your view from the commodities data that we have?
Well, until recently, for commodity producers, it was not that clear that investing in the decarbonization of the production would result in high returns. In commodities, it's not easy to command a premium. By definition, we're talking about a commoditized market, where commodities of the same grade present similar, if not identical, characteristics at the molecular level. But now things are changing, and it is a reasonably safe bet to expect that the regulatory framework will not change direction, that on the long term, the price of carbon will rise, and that consumers will not lose interest in sustainability. So if these 3 points hold true, then commodity producers that embrace change and invest now on the path to net zero will gain a strong market position.
Excellent. Thank you for that. So thanks everyone for the views and inputs, and we're going to move to Q&A now and take some questions from our audience.
So I can kick off with one that's come through. Darren, you're on the hot seat, I'm afraid. So the question is about sustainable infrastructure, and we've talked about the need to accelerate and grow this part of the market. But the question is really, what are the main challenges then? So what's the barrier to actually doing this in practice?
Yeah, well, I think as many as my colleagues have talked through all the different issues impacting this, it's essentially a regulatory framework which is managed country by country. But of course, when we think about power and the supply side, we're talking more on a larger scale now. But each country is moving at a different speed with regard to that regulation. And I think getting that regulation sorted out will allow projects to come forward, financing to be mobilized, both outside of the banks and inside of the banks, to kind of bring things on faster. I mean, generally speaking, it takes 2 to 4 years to build some of these infrastructure projects, and COVID has really delayed, and it needs to happen faster. Governments and regulators really would be a single answer.
Thanks for that, Darren. And I think that picks up on 2 key factors around regulation and financing. We have another question from the audience here, and I'm going to direct this to a few of our experts in the studio today. And it touches on the topic of energy security, around some of the retraction that we've seen coming away from renewable sources and back to more traditional methods of producing energy. And the question is, do you see modern nuclear plants as an option to really help with the transition to net zero? And why don't I start with you, Ed, because you made a comment around how you think that this is potentially a green fuel.
In Europe, France is the nuclear powerhouse, or traditionally it has been. It has traditionally being a really critical supplier of nuclear generated power to its neighbours across Western Europe, and it's accounted for a significant percentage of consumption within France itself. Now, since 2011 and the Japanese Fukushima nuclear incident, which caused Japan to shut down its nuclear fleet for close to 10 years, it caused Germany to make a strategic shift in its decision making around nuclear. There's been a downturn in the confidence in nuclear plants to deliver for energy needs, let alone green energy needs. The current situation, as I said, is causing a rethink around all sorts of fuel requirements in the energy mix, a pragmatic rethink, and nuclear is going to be part of that. We've just seen recently Poland has signed its first nuclear contract with a US supplier to create its first new nuclear capacity, and so there are, I think, baby steps occurring that could see nuclear revitalised. I think it's a decades plus transition. It's not something that happens like that. Darren was talking about 2 to 4 years for certain renewable capacity projects. Nuclear is a lot further down the road than that. So in the medium term, going out to 2025 to 2030, I am biased, but gas and LNG makes a very, very strong argument for increased investment. And indeed, the current situation in Europe has created the biggest ever bull environment for new LNG.
Okay, that's excellent. Thank you, Ed. So I'm keen to keep some of the African perspective here as well. So Ibukun, do you have any thoughts to add to that around the energy mix for their transition? How do you think that will play out?
Yeah, I think it's important to remember with Africa, there are some real existential challenges that the continent faces. I mean, 600 million people continue to not have any access to electricity. You have a commercial and industrial sector which has been underinvested in for many, many years. And it's created a real void of opportunity at the most basic of levels. What seems to worry me, and this is a slightly personal view, is the sense that a lot of the energy transition and the energy mix in Africa should be really driven by a gas strategy, so a gas transition strategy, particularly for the petrostates who have incidental gas or indeed gas that comes in more natural formats. Now, the issue and the challenge with that is that a lot of the governments are specifically looking at the foreign revenue, foreign currency generating side of creating a gas industry which will replace the oil revenues which have really supported these economies over the last 20 to 30 years. Now, the issue with that is that, and I'm going to probably get in the way of our experts' view here, but the long-term view or the medium-term view for the price of gas is that it will actually fall on the basis that there are replacements in Europe for Russian gas, which are not necessarily African gas or gas from other parts of the world, but actually renewables across Africa, green hydrogen, more wind, more solar, etc. So it could potentially be a black hole, effectively, that African governments put themselves down by focusing on those specific elements of the energy transition and using gas specifically. A more broader mix, a focus on developing an African green hydrogen industry, green ammonia and other derivatives of hydrogen is very important, as well as the really natural occurring solar and wind as well.
Excellent, thank you. And that leads very nicely into our next question from the audience here, which is around, are we seeing any progress on European financing for available hydrocarbon infrastructure, and what would that mean for Africa? I'll pass this question maybe to you, Darren, first, and then if you want to add to it, you're free to. So the question is, are we seeing any progress on European financing for hydrocarbon infrastructure?
Well, I think yes. I think the simple answer is yes. The numbers are driving the banks into that direction. They are also under pressure to support their economies and to support the countries that they operate in and that they do business in. And for the banks, the hydrocarbon business is a very bankable product. They know it very, very well. They have done and made a lot of money in this space. I think one of my colleagues on the panel spoke about the reignition of coal-fired power stations, and we have seen that. The Philippines has brought together a project and been financed by banks to build a new coal-fired power station. So yes, there is money available for these hydrocarbon deals, and the banks do support them, despite some of the press that they get for it.
Great, thank you, Darren. And do you see any implications for Africa in this, Ibogun?
Yeah, I think so. I agree totally with Darren. I think there is capital that will continue to support hydrocarbons. I mean, if we take one country, Africa's largest oil producer, Nigeria, about $1.4 billion worth of, 1.4 million barrels of oil per day. Much of that extraction comes from shallow water. So effectively in oil fields which are less than 90 feet deep. Nigeria has huge swathes of the Atlantic Ocean where there's deep water exploration, huge opportunity to make finds like the Jubilee find a few years ago or a few decades ago in Ghana, for example. So ultimately, yes, there is exploitable opportunity, and I'm sure the banks will continue to finance that for the foreseeable future.
Thank you. I'm sorry to say that's all we've got time for today. It's been fascinating, and I, for one, have learnt a huge amount. I just want to close by thanking you all for joining us today and for your engagement and the questions. And thanks also to our expert speakers and sharing their views here today. As a brief reminder, you'll be able to hear from more experts in the following episodes in the coming weeks, so please do join us in the future. For now, though, thank you and goodbye.
We have to have a clear recognition that time is not our friend here.
What's the one thing we need to get right?
It's essential to weave nature into our work.
There are parts of the global financial system that we still need to convince and still need to bring with us.
There is still so much that needs to be done around adaptation and resilience.
Business and finance needs to show up as strongly and as input to COP27 as they did for COP26.
We've got to make this year the year of net zero implementation.